In Chapter 14, we're going to look at two things related to partnerships. One is when the partnership ownership changes and you have a dissolution. Because a partnership doesn't have continuity of life like a corporation, any shift in ownership means the original partnership is dissolved and then it can immediately be reformed with the new composition of partners. So we're going to look at that. The other issue is liquidation. I'm going to show you an example of liquidation, but you're not going to have liquidation in homework just because of the time that we have and the amount of material that we have to cover. So let's get started with exercise 1. With exercise 1, we have two current partners, Murphy and Pearson, and their total current partnership equity is the sum of their two capital accounts, because same accounting equation still holds true here, that assets less liabilities would equal the partnership equity. So the value of equity for the partnership is 110, or in other words, the same thing as book value of the net assets is 110. The fair value is going to be that 110 adjusted for the 30,000 that is given in the text. So that's going to be the fair value of the partnership as we consider admitting this new partner. Now, the new partnership has an implied goodwill potentially. We calculate that by considering the fair value of the new partnership as implied by the price that the partner will pay. So this new partner is willing to pay $84,000 for a 30% interest in capital, implying that the fair value of the new partnership will be $280,000. That means that there's a change potentially in the value of the partnership. Now keep in mind the equity of the new partnership is different as well, or the underlying book value, because we have the 140 of the existing partnership, but then we also have to include the 84,000 this new partner is contributing in cash. So the equity of our new partnership is 224, and thus the goodwill is 56,000, and that's what we're going to take into account in our entries. So there's two entries then related to this. The first is under both methods, bonus or goodwill, you have to adjust for items that are written down. So the accounts receivable write down would be done under either one. The other two for inventory and warranty obligations are only done under the goodwill method, because under the goodwill method we record all changes in valuation. So looking at the amounts in the text, inventory has an increased market value of 58, accounts receivable has actually gone down, and warranty obligations has gone up. So we adjust those to their fair market value. It's a net change of 30,000. That 30,000 is allocated to the two existing partners based on their profit and loss sharing percentages. So Pearson gets 60%, and Murphy is going to get the other 40%, or 12,000. So that's our first entry, just to adjust the values of the existing partnership and get it to that 140. Then we bring in the new partner. The new partner paid 84,000 for their capital account of 84. But we saw that there is goodwill implied by this transaction of 56, and that 56 is again going to be split based on existing partnership profit and loss sharing percentages, and therefore our second entry increases the existing partner's capital for their portion of the goodwill. And hopefully that will help you with homework.